For the past few years, the largest ski resort operator in the world has been none other than Vail Resorts. This massive ski conglomerate owns and operates more than 24 ski areas across North America and Australia, and with recent acquisitions in Europe, the company may not look like it's going anywhere. But recently, a few circumstances have raised some questions about whether some chinks are forming in Vail Resorts' armor. So what's really going on? And is Vail Resorts operating as a truly sustainable business? Well, in this video, we'll figure this out by going through Vail's 2024 earnings report, and then we'll walk you through how its trends will affect skiing and riding for those visiting one of the more than 40 resorts around the world that are operated by Vail. Let's jump in. So let's start with a basic question. How does Vail make its money? Well, if you've been paying attention to the costs of skiing over the past few years, you'd probably think that lift tickets are a big component, and you'd be right. For the fiscal year from August 2023 to July 2024, which Vail Resorts refers to as Fiscal Year 2024, the company recorded over $1.4 billion in lift ticket revenue, which is up 1.5% from the 2023 fiscal year. This lift ticket revenue includes the incredibly popular Epic Pass products. On the other hand, certain other sectors saw notable decreases in revenue. One big drop came from the retail and rentals field, which totaled $312 million in revenue for fiscal year 2024. This is a huge 12.3% drop from fiscal year 2023, totaling around $44 million less in revenue. We don't know the specifics of exactly what caused this, but last year's major drop in skier visits is likely the main culprit, as less people on the slopes also means less people in the stores looking for new skis or renting for the day. Other large contributors to revenue include lodging at $336 million, ski school at $305 million, and dining at $228 million. This all adds up to a net revenue of $2.89 billion, which is surprisingly down just 0.1% from fiscal year 2023. Why is it remarkable that the revenue is down that little? Well, skier visits were down 9.5% last year, from 19.4 million in fiscal year 2023 to 17.6 million in fiscal year 2024. It's no secret that last winter was not the best snow-wise, and the drop among Vail-owned resorts was greater than the US nationwide, which saw an overall skier visit drop of just 7.6%. One major reason for this drop was the horrible season for Midwest hills, especially in the lower parts of the region. In this area of North America, the natural weather was an absolute disaster. Hills such as Mad River Mountain and Alpine Valley in Ohio, Snow Creek and Hidden Valley in Missouri, and Paoli Peaks in Indiana all had some of their shortest seasons on record. This very well likely impacted other regions as well, as local skiers to those hills may have canceled trips out west after seeing the dissuasive conditions at hand. Compared to other multi-mountain companies such as Alterra, Powder, or Boyne, Vail Resorts owns far more Midwest mountains than its competitors, with 9 under its belt, compared to the other mega resort companies, which between them only own a combined 3. According to the National Ski Areas Association, the Midwest as a whole saw an astounding 26.7% drop in skier visits from last year, which was the most of any US region. But despite this huge drop in skier visits across the Vail Resorts portfolio, one number that helps explain why the revenue barely dropped is the effective ticket price, or ETP. This is the average amount a skier or rider pays for one day of lift access across all Vail Resorts owned mountains, and this metric is found by dividing lift revenue by skier visits. It's important to note that ETP takes into account all forms of access, ranging from the incredibly expensive day ticket purchases to Epic Pass holders skiing over 100 days and getting the bargain of a lifetime. You probably already know where this is going. While skier visits were down, Vail's ETP most certainly was not. The ETP for fiscal year 2024 was $82.14, which is a whopping 12.2% increase from the fiscal year 2023 tally of $73.20. A big reason for this was the steep increase in regular lift ticket prices. While Epic season and day pass prices only increased by around 8% versus the prior year, regular lift ticket prices increased a lot more. Although the average lift ticket prices at already expensive places like Vail and Beaver Creek went up by less than 10%, destinations that used to be slightly more reasonable saw massive price changes. For example, the weighted average lift ticket prices for each of North Star, Heavenly, Stowe, Stevens Pass, Park City, Keystone, and Okemo went up by over 15%, while the weighted average ticket price for Whistler Blackcomb, which is the company's only Canadian resort, went up by a staggering 36% from $144 US to $196 US. That is a completely insane year-over-year price hike. It seems that the trend of declining visitation but increased revenue may continue next season, albeit potentially to a lesser extent. A couple of weeks ago, it came out that Vail Resorts' 2024-2025 Epic Pass sales through the summer dropped 3% compared to the prior year, although pass revenue was actually up 3% thanks to another 8% across-the-board price increase this season. It actually seems that this summer's sales saw some improvement from the early bird spring renewal period, with existing pass holders making up their minds later than usual, but fewer new pass holders than in years past. Especially when considering that the company's mountain portfolio hasn't changed all that much in the past 5 years, it's possible that Vail Resorts has hit its ceiling for growth in the North American market. For now, Vail Resorts may be able to keep its revenue flat by continuing the price increases, but this strategy does not seem like a winning one for the long term. It's also worth briefly touching on Vail Resorts' lodging revenue from last year. While the segment did drop slightly from the prior year overall, the changes by lodging type have been more drastic. The hotel, transportation, and golf sections of Vail's portfolio saw growth of 4.8%, 7%, and 7.7% respectively, while on the other hand, the Vail Resorts managed condos saw a decrease of almost 11% from fiscal year 2023. The decrease in condo revenue tracks with a lower visitation, but it's somewhat surprising to see revenue from hotel rooms continue to grow despite last year's trends. But upon a closer look, it becomes apparent why. The increase in hotel revenue came in large part thanks to increased visitation at Grand Teton Lodge Company, which provides accommodations that only operate during the summer months. So yeah, Vail Resorts' winter lodging took a huge hit as expected, but the company was actually able to hedge on this with a sizable boost in summer visitation, albeit to accommodations that most people don't even know that they own. But perhaps the most shocking thing in Vail's earnings report is what we see with ski school and dining. Despite the double-digit drop in retail and rentals, the ski school and dining sectors both actually went up in revenue for fiscal year 2024. Dining went up by a modest 1.3% versus the prior year, but ski school revenue actually increased by a pretty eye-opening 6%. And unlike with lodging, there wasn't a summer offset to boost these metrics. Vail Resorts claims that these revenue increases were due to an increase in guest spending per visit at their resorts. But then when you look at the fact that dining and lessons are still recovering from the COVID era, and that one-day lessons could cost as much as $1,560 at Vail's highest-end resorts last winter, maybe this begins to make a little bit more sense. Finally, given the massive drop in rental revenue, it's also worth briefly touching on Vail Resorts' highly publicized introduction of My Epic Gear, a membership program intended to offer access to premium ski and snowboard rental equipment on a subscription-level basis. In its inaugural year, My Epic Gear was anticipated to drive revenue, but the short-term contributions for this program, which was piloted at a handful of destinations last year, seem to have been modest, leaving it unclear whether it helped offset the significant drop in revenue in the rentals category in any notable way. So that's how Vail Resorts makes its money, but what's costing Vail Resorts the most? Well, like most companies, it's employees. On the mountain side of things, labor costs made up around 42% of operating expenses, or $731 million out of $1.74 billion in operating expenses total. Next up is the other category, which can include capital expenses at ski areas or new acquisitions, such as the recent addition of Crans-Montana in Switzerland. The other category makes up $444 million, which is up from the $424 million expense in fiscal year 2023. In lodging, there was a bit more movement, with lodging expenses dropping by 4.6% from $328 million in fiscal year 2023 to $313 million in fiscal year 2024. This was largely due to drops of over 6% in both payroll and general and administrative expenses versus the previous fiscal year, which, in other words, was basically the company employing fewer hotel and condo workers to account for the decrease in demand. And as we'll discuss later in this video, this decrease in employment may be an omen of things to come. So if you take net revenue and subtract net expenses, what do you get? EBITDA, of course. EBITDA, or earnings before interest, taxes, depreciation, and amortization, may not be the most simple statistic on the surface, but it allows us to get one of the best measures of something that's a lot easier to understand, Vail Resorts' profitability. In fiscal year 2024, Vail's EBITDA was $827 million, a small drop from fiscal year 2023 when it was $833 million. However, the way the company got to this number this past fiscal year changed a bit versus the year before. Mountain operations EBITDA decreased by $20 million from 2023 to 2024, but lodging EBITDA increased by over $10 million, which was in large part thanks to both the summer revenue and the decrease in labor costs we mentioned earlier. The decrease in mountain operations EBITDA is largely due to the $44 million drop in retail and rentals revenue, as we discussed earlier in the video. Ultimately, when accounting for interest, taxes, depreciation, and amortization, Vail Resorts made over $230 million in net income during fiscal year 2024, which is slightly down from fiscal year 2023, when the net income was $268 million. Still, $230 million in profit isn't chump change, and when you compare that to where Vail Resorts was a few years ago, the change is still substantial. Speaking of a few years ago, while the trends from fiscal year 2024 are interesting on their own, they only show a snapshot of the whole story. Vail Resorts has seen massive changes over the past 5 years, with more than 20% growth in effective ticket price, over 30% growth in total skier visits, over 40% growth in total revenue, and over 130% growth in net income attributable to the company since fiscal year 2020. Now, fiscal year 2020 was greatly affected by the COVID pandemic, and a handful of small Northeast resorts and European regions have been added to the portfolio within the past 4 years, but even year-over-year growth has been largely consistent since then, with the only real slowdown coming in the past year. So, if Vail Resorts has maintained a pretty consistent revenue over the past year, why has its stock price gone down so much? As a public company, Vail sells stock on the New York Stock Exchange under the ticker symbol MTN. The stock reached its peak in 2021, selling for over $370 per share at that time, but it's dropped substantially since then, and it's now under $170 per share. This is all despite the huge growth numbers seen during 2022 and 2023. Well, stockholders had been banking on a continuation of previous growth, and Vail's profit forecast came in lower than expected this year due to the factors we mentioned earlier. So while its income may not have changed all that much versus the year before, Vail Resorts is a public company, and whether you like it or not, this ultimately means that the company's primary loyalty is to its shareholders, not its visitors. The company had to figure out some way to pump up its stock, and the same day as the release of the fiscal year 2024 fiscal review, Vail Resorts released a quote-unquote resource efficiency transformational plan, and they kind of buried the lead in their fiscal review. In a separate press release, they state the transformational plan will focus on cost efficiencies, which will include, quote, position eliminations impacting less than 2% of the company's total workforce, including 14% of its corporate workforce and less than 1% of the company's operations workforce. So if you're currently working at Vail Resorts in Broomfield, Colorado, you may not have the best job security right now. Okay, so if Vail Resorts is cutting part of its workforce, what's going on with the top level of its executives? Well, being a public company, Vail Resorts does have to release the compensation for its entire executive board. So let's take a look at how much their CEO Kristen Lynch is paid and how that compares to the average employee. During fiscal year 2022, fiscal year 2023, and fiscal year 2024, Kristen Lynch earned more than $6 million in compensation. But all CEOs make an absurd amount of money, right? So how does the CEO's compensation compare to the median employee? Vail also releases the ratio of pay between the CEO and the median employee, and it is worth noting that after the ratio reached record levels of 128 to 1 in fiscal year 2023, it did drop back to 112 to 1 in fiscal year 2024. However, this ratio is still well up from fiscal year 2022, where the ratio was 79 to 1, and fiscal year 2021, where the ratio was 94 to 1. While Kristen Lynch's salary has remained relatively stable over the past 3 years, the median employee's salary has been all over the place. For the ratio of pay formula, Vail Resorts normalizes median pay to a full year, as many employees are seasonal due to the nature of ski resort jobs. In fiscal year 2022, the median annual salary for a Vail Resorts employee was $70,000, but this dropped to $48,000 in fiscal year 2023, then it bounced back to $56,000 in 2024. It's especially interesting to see this discrepancy swing in the downward direction in recent years, given that the company raised their minimum wage across all positions to $20 an hour for fiscal year 2023. Now, the average pay ratios for companies on the S&P 500 is 268 to 1, so Vail is far from the worst offender. And with the ratio going down this year with flattening growth, the company seems to be adjusting compensation based on performance. But still, if you're looking at this as an outsider, it may not look like the best approach to have your CEO making over $6 million while firing 14% of your corporate workforce. So now we get to what might be the most important part of this conversation. What does Vail Resorts' flattening revenue mean for the future of its resorts? Well, one place to look is at the company's on-mountain capital investments, which have significantly declined over the past 2 years. In 2021, when the stock was at its peak, Vail Resorts announced nearly 20 new lifts set for completion in the following year. Now, they're adding fewer than 5 lifts annually. Unlike the game-changing investments seen at Keystone, Beaver Creek, and numerous other resorts in past years, only 2 locations, New York's Hunter and Canada's Whistler Blackcomb, are getting new lifts this year. Next summer, the only planned lift installation across the entire Vail Resorts portfolio is the new Sunrise Gondola on the canyon side of Park City. While the high investment levels of the early 2020s may not have been sustainable, this sharp decline has certainly raised eyebrows. This decline becomes especially apparent when you look at the number of lifts Vail Resorts operates across the world, over 200, and furthermore, the number of lifts reaching the end of their useful lives, which, if you generously only look at high-speed detachables that are over 30 years old, still totals over 24. Vail Resorts is going to need to replace these lifts at some point in time or another to meet basic life cycle requirements, and if the rate of replacement over the next 2 years becomes the norm, the medium-term future for the company is not going to be pretty. One place that may still see renewed investment, however, is Vail Mountain itself. The long-anticipated West Lionhead base area now appears to be finally happening. Not only will the base area provide a new way for visitors to access Vail's 5,300 acres of skiing and riding, but more importantly, it will provide more workforce housing, which is incredibly hard to come by in the notoriously expensive, arguably NIMBY-controlled town of Vail. So on the surface, Fiscal Year 2024 was far from the worst year it could have been financially for Vail Resorts, but serious concerns have surfaced about the long-term sustainability of the company. For the average person visiting a Vail Resort this next season, the company's spending decisions may be a bit head-scratching. But ultimately, the company might be okay with putting off some investments or removing lower-level corporate positions, but the stability of the CEO job, whether you like it or not, is a top priority for a publicly traded firm like this. Whether these decisions blow up in their face over the next few years, however, is still yet to be seen. The next few years will be incredibly important not only for Vail Resorts, but for the ski industry at large. Love it or hate it, Vail Resorts has a huge impact on the ski industry, and if they're on the decline, many others in the industry will likely suffer as well. Also, while the other ski resort megacorporations do not have publicly available financials, Vail is far from the only company pulling back on investments. The company's main competitor, Alterra, has scaled back quite a bit on new lifts over the next year or so, and an additional competitor, Powder, is selling off several ski resorts in its portfolio, which has been totally unprecedented within the last few years of the ever-consolidating ski world. While investors are bearish on Vail, we'll be following along to see if the company can earn back the trust of skiers and investors alike and maintain its status as the top mountain operator in the world. If you found this information helpful, be sure to like and subscribe and hit the bell so you don't miss any of our content. And special thanks to our Peak patrons. Blue Square members and above get access to our mini Peak pod, where this week we'll be ranking Vail's 24 aging lifts in order of okay as is to dire replacement need. For more information on the mountains owned by Vail Resorts and over 100 ski destinations around the world, check out peakrankings.com. See you for the next one.